So, good evening, friends. We will move into Indian Partnership Act 1932, where we will be discussing one type of borrower, partnership firms, right? In order to bind the firm, in the last session, we told you that we discussed that the partner can bind the firm through any of his act, except in certain cases. Now, in order to bind the firm, the partner must do the activities under the name of the firm. Number one. Number two, he should execute the documents on behalf of the firm. Unless he does the activities under the name of the firm and executes the document on behalf of the firm, he is not binding the firm. And that is the reason why, friends, we told you that the partner has to sign by affixing the partnership firm's seal, so that he is doing it under the name of the firm. Okay. And all the partners are jointly and severally liable for the acts of the firm. What is meant by joint? Jointly means it's a joint liability. If the partnership firm has probably 4 partners and it has borrowed 10 lakh rupees, each partner is jointly responsible, right? All of them are jointly responsible to pay. And severally means they are individually also responsible to pay. That means if 3 partners say that I am not able to pay for any reason, they become insolvent, right? Then only the other partner who is solvent, he has to settle the dues of the firm. That is why it is called joint and several liability in case of partnership firm. The rights of a partner can be restricted through a partnership deed. Whatever the rights the partner has, it can be restricted through a partnership deed. And if someone who is dealing with a partnership firm is not aware of such restrictions, is not aware of certain restrictions, then the firm would be liable for the acts of the partner in spite of the restriction in the partnership deed, right? Companies Act 2013, minimum number 2, maximum is 100, but the central government has for the time being restricted the maximum of partners in a partnership not to exceed 50. Okay. A minor can be admitted to the benefits of the firm, but there should be at least 2 major partners, right? Only if there are 2 major partners, a minor can be admitted to the benefits. What does it mean? It means a partnership firm cannot be started with minor as a partner. While commencing a partnership business, a minor cannot be a partner there. But after the business is commenced, with the consent of all the partners, a minor can be admitted to the partnership only for the benefits of the firm. So he cannot be held responsible or liable for the loan that you give to the firm. He is there only for the benefits of the firm, right? Then what is the liability of a minor partner? Now, on attaining majority, the minor partner shall become a normal partner, or he has an option to quit the partnership, right? After giving due notice to the public and informing the firm, the register of firms and assurances. And this he should do within 6 months of attaining majority. If he does not do it within 6 months of attaining majority, it is deemed that he has decided to continue as a partner. And once he continues as a partner, he is liable for all the acts that the partnership firm has done during the minority of that particular member. Now we cannot say, I was a minor at that time, I am not liable. But since he has become a partner now, a normal partner, his liability goes back even to the days when he was a minority partner, when he was minority, right? He was still a minor, right? Then a partnership firm, a trust, an association or a society or a HUF cannot be a partner in a partnership firm. For example, can a partnership firm be a partner in another partnership firm? The answer is no. Can a trust be a partner in another partnership firm? Answer is no. Can an association or a society or a HUF can become a partner? Answer is no, right? A company or a LLP can become a partner in a partnership deed. But the other entities, partnership firm, trust, association, society, all these cannot become partners in another partnership, right? The debt, lunacy or insolvency of a partner stop operations. I'm not talking about current account. I'm talking about the loan given to the partners. If it is a cash credit limit, you will have to stop operations in the limit on the debt, lunacy or insolvency of any partner, not necessarily the authorized partners, because you will have to avoid the application of Clayton's rule. This is a very important rule, friends. In the coming slides, I'll give you with an example how the Clayton's rule works when we look into a statement of account of a CC limit. But as soon as a partner dies, he becomes lunatic or insolvent, you have to stop operations in the CC limit, in the cash credit limit or the overdraft limit. It may not apply to term loans, because term loan is not an operative limit, whereas a CC limit is an operative limit. Okay. Now, while granting loans to the partnership firm, you will have to take some precautions. What are they? Firm is to be registered. I told you, before we sanction loans to a partnership firm, we have to ensure that the firm is registered with Register of Firms and Assurances. We also discussed in the earlier session what are the implications of a firm not being registered. I will again repeat it. If there is an unregistered firm, the firm cannot sue third parties for the dues that they owe to the firm. And whereas third parties can sue the firm even if they are unregistered. Number two, the partners cannot sue each other or the firm for any of the dues. Right? These are the two very major disadvantages if the partnership firm is not registered. So while giving a loan, we ensure that the partnership firm is registered. Then you have to scrutinize the partnership deed for any provision that may put the loan in jeopardy, that may put the loan in some risk. You have to look into the partnership deed, right? If a partner is a company or a LLP, then whatever loan you give, whatever charge you create on the assets of the partnership firm, you have to get it registered with ROC. This might be a question. If a partner in a partnership firm is a company or a LLP, the charge on the assets of the partnership firm is to be registered even with the ROC, right? Now, friends, have a look at this. Have a look at this statement very carefully. What do you find from this statement? Let us see on 1/12/2025, the debit balance in this account. We will assume that this is a CC limit. Debit balance in this account is 10,45,000. Then 4/12/26/12, some debits are there. The balance as on 26/12 is 11,68,000. Okay. See here very carefully. On 1/1/2026, on 4/1/2026, there is a credit into the account of 4,75,700. Now the balance in the CC limit has come down from 1193 to 718, right? It has come down to 718. Now let us assume on 1/1/2026, you get an information that a partner has died or he has become lunatic or he has become insolvent. So on 1/1/2026, you have to freeze the operations in the account. That means you should not allow further credits into the account or further debits in the account, because Clayton's rule will apply in such case. What is Clayton's rule? I will tell you what it is as per the textbook. Every credit in the loan account after the death, lunacy or insolvency of a partner, this is particular case of partnership firm, it amounts to discharging the earlier debits. Now let us assume 1/1/2026, the partner has died. One of the partner has died or has become lunatic or has become insolvent. Now, what was his liability as on the date of his death? It was 11,93,000. But now, as on 4/1/2026, after his death, you have given a credit of 4,75,000 into the account. That means his liability, his legal estate, will be liable only for 7,18,000 in the now. Even though next day you have passed another check, 3,45,000, right? even though you have passed another check and the balance has gone up to 10 lakh 63,000, he is liable only for 7 lakh 18,000, the estate of the deceased partner. This is called the Clayton's rule. So what do we do? What do we do? If we stop operations in the account, will it not amount to putting restrictions on the running of the business? How will the business continue? That is the question that we have to answer. Now, friends, you will have to see what is the limit. Let us assume in this account, the limit is 15 lakh rupees. The balance was on 1/1/2026 when the partner has died or become insolvent or he has become a lunatic. The balance is 11 lakh 93,000. So what the banks do, the difference between the original limit and whatever is the balance on the date of death of a partner, they will transfer that to another account, same CC limit, and they will allow the other partners to operate that limit so that no credit is given to the original limit of the partner to avoid Clayton's rule. So Clayton's rule says every credit given subsequent to the death of a partner discharges the earlier debits in a chronological manner. First credit discharges the first debit. Second credit discharges the second debit. So it discharges the debit in a chronological way. So that is why we should not allow operations in a operative account, CC limit of a partnership firm subsequent to the death of a partner, right? Yeah. Now, we'll talk about HUF. HUF is not registered under any specific act. It is a legal entity that is recognized under Hindu law. It applies to Jain, Sikh and Buddhist families as well. The eldest family member is the Karta or the manager. The Karta looks after the whole business. Position is by birth into the family. Members are called co-parceners. Karta's liability is unlimited, whereas the co-parcener's liability is limited to their share in the business, whereas the Karta's liability is unlimited. There are two schools of thought, friends. HUF can be formed under two schools of thought. One is Dayabhaga, the other is Mitakshara. The other day, while discussing liability deposit accounts, I told you I will explain about this when we discuss the loan accounts. Now, friends, listen carefully. Two schools of thought under which HUF can be formed, Dayabhaga and Mitakshara. What is the difference? Mitakshara grants male members rights to ancestral property by birth. That means if a HUF is formed under Mitakshara law, the male members of the family get a share, get a right to the ancestral property by birth, right? But by 2005 amendment, by an amendment that was passed in 2005, this gender bias is removed and for HUFs formed under Mitakshara law. That means daughters born into the family are also eligible to get a right in the ancestral property by virtue of their birth in the family. From 2005, this has been changed, right? Dayabhaga, here the sons do not have a right when the father is alive. That means when Karta is alive, none of the co-parceners have a right. In Mitakshara, a co-parcener cannot sell a share without the division of property. Whereas in Dayabhaga, the Karta has got absolute right to sell the property, even without the consent of the co-parceners, because the father is the absolute owner. He has got absolute control and ownership. So he can dispose of the property without the consent of the sons. How do you know whether it is formed under Mitakshara or Dayabhaga? HUF, it will be there, but then Mitakshara is followed in all parts of India except West Bengal, Assam and Tripura. Whereas Dayabhaga is followed in Assam, West Bengal and Tripura only. In all other parts of the country, Mitakshara law prevails, right? Under Mitakshara again, any co-parcener can seek division of the property even when the Karta is alive. But whereas in Dayabhaga, the property can be partitioned only after the father's death, that is the Karta's death. Okay, so these are the differences. Women members also inherit property at par now. For in case of HUS formed under Pitakshara, right? What are the precautions you have to take? Application to open the account is to be signed by the Karta and all major co-partners, right? Adult members should be, they should join, and we should also take them as guarantors so that ultimately you will make them jointly and severally liable, right? On the death of the Karta, senior most member will take over as Karta. That means HUF has got a perpetual existence. When the senior most member dies, who is a Karta, the next senior most member takes over as Karta. If there are no senior major male members in the family, a female, the eldest female, can also be a Karta. Okay. When is the HUF closed? On partition or division of the property or business, the HUF ceases to exist. There is nothing called a HUF agreement. All they have to give is a letter saying that we, the family members, have formed this HUF. That's all. There's nothing called a document or agreement. Okay. Now we come to companies. A company is a legally constituted entity under a company law. Since it is not naturally born, we call it an artificial entity. Any company should register itself mandatorily with ROC. If it has to start the business, or if a company has to be floated, it has to be registered with ROC mandatorily. A company may enter into contracts. A company may enter into contracts in its own name and can also be fined for violation. So because it's an artificial entity, it's an artificial person. Okay. It can acquire and dispose properties in its own name. A company can sue and be sued in its own name. That means it can file a suit and others can file a suit against it. A company is a legal entity separate from its members, right? Even though there are directors in the company, shareholders in the company is different from its members. Minimum 2, maximum 200 in case of private limited company. Minimum 7, maximum no limit in case of public limited company. This can be a question. In private limited company, minimum 2, maximum 200. In a public limited company, minimum 7, maximum no limit. Okay. What are the essential features? Limited liability. Limited liability means the liability of the directors who have signed the agreement, if a company borrows, is limited only to the extent of their share in the company. That means the personal assets of a director cannot be attached for the dues of a company. Whereas in case of partnership firm, it is unlimited. So the assets of the partners, individual partners, can also be attached for the dues of the partnership firm. But in case of company, it is limited liability. Even in case of LLP, limited liability partnership, the liability is limited. Perpetual existence. The company does not cease to exist unless it is either liquidated or it liquidates on its own, right? Either it's liquidated by law or it self-liquidates itself. It continues to exist. The death of the shareholders, the death of the directors will not result in dissolution of the company. Transfer of shares. In a public limited company, the transfer of shares is, as all of you know, it's free. Anyone can sell the shares that he has purchased a public limited company in the stock market. But in case of private limited company, the transfer of shares is within the family itself. It cannot be transferred outside the family. Common seal. Common seal, friends, nowadays you don't find that because it is not mandatory as per the company law. Common seal is a metallic seal which had to be pressed on the documents which is executed by the company. It was a metallic seal, but nowadays common seal, the Companies Act 2013 has done away with common seal, right? Corporate will. corporate will, though a company is a separate legal entity, the company, but you will have to appreciate that it is nothing but an association of persons, all shareholders getting together. That's all, nothing else. So the court may, at some point of time, if the company is not functioning in the public interest, right, then the court can lift that corporate will and say the company and the shareholders are not independent of each other. They are, in fact, one and the same. If the corporate will is lifted, and it can be lifted by the courts. Okay. And what are the different types of companies that we have? Private limited company and public limited company. Major. A private limited company where the minimum paid up capital stipulation is waived. That means if I have to start a private limited company, I need not have a minimum paid up capital. That stipulation is waived. Whereas then shares not freely transferable, that is not open to public subscription. Shares of a private limited company not open for public subscription. Total number not to exceed 200. Acceptance of deposits from third parties is prohibited in case of a private limited company, right? Public limited company, which is not a private limited company, it is a public limited company, right? So public limited company, they will only use the word limited against them. ONGC, they will only use the word limited. They will not use the word private limited. Whereas a private limited company has to use the word private limited. The public limited companies will only use the word limited. So minimum 7, maximum no limit. They can issue shares, debentures, and they can also accept amounts from the public wherever permitted. Whereas private limited companies cannot accept deposits from the public, right? What are the different types of companies? One, we have a government company. A government company is one where the government share, either a state government or a central government, or both of them put together, where their share exceeds 51% of the capital of the company. That is a government company. For example, ONGC, IOC, Indian Oil Corporation Limited, BHEL, GAIL, Gas Authorities of India Limited, HAL, SAIL, Steel Authority of India Limited, LIC, SBI, right? All these are government companies because the government holds more than 51% share in them, right? And if there is a subsidiary company of that government company, it is also called government company. What is a subsidiary company? We will discuss it later on. Okay. Section 8 companies. Section 8 companies are companies which are formed on no profit, no loss basis. That means these companies, right? These companies, they play a key role in bringing a social change, right? They use profits to support causes aligned to their objective. It can be social cause like education, healthcare, environmental protection, rather than distributing the profits to the shareholders. So these companies, Section 8 companies, they of course make profits, but they use the profits not to distribute to the shareholders, but to further the objectives of the company. For example, BCCI is a Section 8 company, Infosys Foundation, Azim Premji Foundation, CRI, Child Relief Fund U, Smile Foundation, Akshaya Patra Foundation, all these are Section 8 companies. They may make profits, no doubt, but the profit is used only for the objective for which they have been established. Then we have got foreign companies. Foreign companies are companies which are having headquarters in another country, but they have a branch in India, right? They have a branch in India. It can be a physical branch, or they may be doing business in India, like these, what do you call them? E-commerce platforms, right? Foreign companies headquartered abroad, but having presence in India. Google, Accenture, Toyota, Visa, MasterCard, right? All these are companies which are headquartered outside India, but they have a presence in India. One-person companies. Nowadays you can start a one-person company also. One-person company is there is only one person who has started the company. But friends, you have to link it to the features of the company. What are the features? Perpetual existence is a feature, correct? That means even if the shareholder is not there, even if the promoter is not there, the company should continue its business. So in case of one-person companies, if the person forming the company dies, what will happen is the question. That is why in case of one-person companies, at the time of forming the company, that one person has to nominate someone who will run the business after the death of the promoter. And in this case, the nominee, it is not for bank accounts. The nominee is to manage the business. The nominee is to run the business. So the consent of the nominee is also required. It is not enough if one-person company nominates someone, but the consent of the nominee is also required to be filed with ROC, right? Then small companies. What are small companies? This can definitely be a question. What are small companies? Right. The threshold limit, friends, listen carefully. 50 lakh paid up capital or 2 crore turnover. Then it is a small company, right? The small company is one where, sorry, I'm sorry. I'm sorry. It has been revised now. A small company is one whose paid up capital does not exceed 10 crore and where the turnover does not exceed 100 crore. That means if any of these companies are formed and the paid up capital does not exceed 10 crore and the turnover does not exceed 100 crore, it is called a small company, right? This change in definition is done during December 2025. Okay. Yeah. Then remember 10 crore paid up capital. A small company is a company where the paid up capital does not exceed 10 crore and the turnover does not exceed 100 crore. This is the latest definition. Okay. Then you have got producer companies. What are producer companies? In case a company is formed with minimum 10 producers of the same product, producers of the same product, they get together and form a company. It is called a producer company. Again, maximum members, no limit. Okay. Number of directors will be minimum 5 and maximum 15. The status will be private limited company. Okay. Now, the next is dormant company. What is a dormant company? Dormant company is one where the business activity is not done for the last 2 financial years. No business activity is done for the last 2 financial years. That means it's a dormant company. Holding company and a subsidiary company. What are holding companies and subsidiary companies? For example, if one company controls another company, maybe through the composition of board of directors or holds majority voting rights, that company which is holding the majority voting rights in another company is called a holding company. For example, if State Bank of India, which is a company, it floats a subsidiary, maybe to carry out wealth management services or to carry out factoring and forfeiting services, which we'll discuss later on, right? Then holds the maximum share in that company. The company floated by SBI will be called a subsidiary company and SBI will be called a holding company. So these are the different types of companies that we have. In company, what is that you will have to see? Mainly you have to take 2 documents, MOA and AOA. The other day we discussed this. MOA is the external and public document. Every company should have a MOA, right? The document facilitates the shareholders and the creditors to know what is the objective of the company, why the company is run, where is its registered office, what is the liability of its members, what is the share capital, right? All this information which the public needs to know about a company is mentioned in the memorandum of association. For a banker, what is very important is the objective clause. Why it is important, we'll discuss as we go ahead, right? Uh, Bank has to peruse the MOA. They have to go through the MOA and find out whether the lending is in conformity with MOA. There's an objective clause. In the memorandum of association, the company says, we have started the company because this is the objective of the company. We have started this. And any loan you give, the bank gives, should be aligned to the objective of the company. If you give loan for any other purpose, then it is ultra wires. You cannot recover the loan. For example, if a MOA says that a company is established to run a chain of educational institutions, then what are the purposes for which you can give a loan? You may lend for any purpose connected with the objective. For example, building classrooms, building hostels, purchasing vehicles for transporting students, construction of lab. All these are aligned to the objective. What is the objective? Running a chain of educational institutions. But if the company comes to you and says, we want to build a resort, so please give us a loan. You cannot give a loan because that is not the objective of the company, right?